Morning, Market Chameleons. Thanks for joining us for the pre-market show on Tuesday. How are you doing, Dima?
Good morning, Will. How are you?
Awesome. Great webinar last night, buddy.
Oh, thank you. Yeah, well, thanks everyone for joining. That was great.
I mean,
everyone had some great questions.
Yeah, everyone loves learning about the intricacies of straddles on a Monday evening, right before the Jets Monday Night Football game. But it was a great webinar. I put out the link. I recommend it to everyone. With that, Dima, you want to get started?
Yep. So before we start, let's do the disclaimer really quickly. Everyone keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, contact your broker. That's what they're there for. They should be able to help answer your questions, provide you with guidance. There's the disclaimer. And with that, yep, let's get started. Let me see what I have on the agenda today. So I think I wrote it down. I think we'll start with the pre-market report. We'll do a couple earnings. I think I'm going to do maybe a fundamental analysis of two stocks. And then, actually, let me see if for some reason I'm not logged into my own session. And then we'll take a look what was moving yesterday. Yesterday was a big day, a lot of rotation out of some stocks into other stocks, given the news that we have a potential vaccine for that coronavirus. So let's get going with the pre-market report. These are stocks moving into pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to take a look first at stocks that with a higher market cap, see what's going on there. So I'm going to use this filter market cap, 20 billion market cap or higher. And here we got a big list of stocks that, let me see, 45 on the biggest percentage gainers list, 42 in the biggest percentage decliners list. So about even, a little bit tilted more towards a more positive side, but right about even. Some of them are in earnings. I see BP, that's up 7%. I think those are energy stocks popping back up due to this corona, due to that potential vaccine. So these stocks have been really hit during the coronavirus. That energy sector has been like, I don't know what, we could take a look at it, but it's down significantly in the S&P 500.
Yeah, well, it was being hit before, and this was pylon. Everyone staying at home was pylon.
They're already weak, and this was just like, when just bad news follows more bad news, and this was like a pylon. Maybe this, if you're playing that recovery, going out of stay-at-home stocks to going out stocks, because we saw, cruise lines up, restaurants up, airlines up yesterday. So the energy sector, if that's true, everybody starts going out, people start driving more, traveling more deliveries. That might be one place that was very weak, and we'll take a look what people were doing yesterday in that energy sector in the ETFs. But that might be one place to play that recovery with the vaccine. And I think they also have like some treatment, right? Eli Lilly.
Yep, Eli Lilly announced a treatment for people who are at severe risk, and they are shipping it already.
Oh, really? Okay.
Yeah.
Here we go, 4%. Eli Lilly, Amgen up 4%. So maybe we're close. We are close then to turning that curve and start our way out of that coronavirus. Let me take a look at the unfiltered report. Unless you have questions, I'm not going to spend too much time on it. I see Beyond Meat that reported earnings yesterday down 22%. That's an interesting story here because.
And you like that product, don't you? You
know what? My wife likes it. She doesn't like to eat meat a lot. She likes fish, and she tries the plant-based meat, and she did buy a couple times. I think we tried the burgers. We tried. I think they have like a bacon version. We didn't like it. Have you tried it, the Beyond Meat?
We did in a very early episode when this thing was way, over $100. We had a little session on the barbecue, my brother and I, and it got mixed reviews. And by the way, at the time, and I haven't priced it recently, it was almost twice the cost of buying a burger patty. So,
yeah, if they could bring those prices down, I think they started making some deals even with some fast food chains, maybe Pizza Hut. Let me take a look.
Goat Roper's informing us. I think there's a lot of estrogen in Beyond Meat patties. So be careful out there.
Wait, what does that mean? There's a lot of what?
There's a lot of estrogen. So, I mean, it's a synthetic it's a product of mixed ingredients, right? So he's just, and I know his wife is a healthcare professional. He's letting us know that there's a lot of estrogen in the patties.
So that could be a bad thing.
And he could also be pulling my leg. I have no idea, but that's what he's saying on the chat.
All right. Well, any case, they're down 22%. Looks here, I'm just reading one of the headlines. Pizza Hut partnered with Beyond Meat. Some speculation, maybe McDonald's will as well. Anyway, let me just take a look here on similar stuff. I just want to see their fundamentals really quickly, and they probably changed given, the fact that it's down this much. But here's Beyond Meat. Let's see if any other ones are moving on the. So here's Beyond Meat down 22%. I don't see anything drastically moving with that news. On the fundamental side, this is prior to this report. So we see here, very large P, but they must have had some positive earnings. So looks like they did make some profits, up to now. Price to sales 23, so compared to, that industry, that group of 1. So that's pretty high. Price to book is pretty high. Gross margins 34.3%, at least up to now. That seems like pretty decent for that food industry compared to 26.2 in that group. Here's its revenue growth, 5-year average 67% versus 4.1% in that group. Probably these numbers changed, their gross margins, growth rate since it's down 22%. But that's a quick look at Beyond Meat, and we'll see how that does. And do they have like patents on these things? Well,
I am sure they have some patents. Yes.
All right.
But I know that doesn't mean there's not a lot of competition. Actually, Goat Roper said McDonald's is actually also exploring their own meatless patty. So just an FYI.
So they could be a competitor.
Right? Yeah. And there are competitors out there. There are definitely other products on the supermarket shelves already. So.
Right. Okay. So, they're not the only ones in that space. It could be very competitive. Let's take a look at what's coming up unless you have questions.
Nope, move forward
on this. Let's take a look at what's coming up on the earnings front. Then I did want to get to a couple other reports. So these are we're going to take a look at stocks expected to report earnings in the next 2 weeks. Let's filter out stocks that on average trade at least 5,000 contracts or more per day. Here's a list of companies here. I'm going to try to spot some familiar names. Here's Lyft. That's expected to report today after the market close. Right now, as of yesterday's close, that straddle was implying a move of 9.9% in either direction, and that compares to a 4-quarter average move of 10.8% and a 12-quarter average move of 9.5%. So we see the current move that's almost 1% below that 4-quarter average, 0.4% above that 12-quarter average. The high move in the last 12 quarters in that stock was 21.7%. Disney, they're expected to report November 12th after the market close. Right now, the straddle is implying a move of 4.9%. That's compared to a 4-quarter average move of 3.8% and a 12-quarter average move of 2.6%. So we're 1.2% above that 4-quarter average, 2.3% above the 12-quarter average, and the high move on Disney in the last 12 quarters, 8.8%. Cisco also November 12th after the market closed, the straddles implied a move of 6.3%. That compares to a 4-quarter average move of 7.1% and a 12-quarter historical average move of 5.6%. So we see a little bit below that 4-quarter average, 0.8% below that 4-quarter average, 0.6% above the 12-quarter average with a high move of 11.2% in the last 12 quarters. AMAT also November 12th after the market closed, straddles implying a 5.1% move in either direction. That's right in line with the 4-quarter average. 12-quarter average move 4.3%, so we're 0.8% above that. And the high move on AMAT is 9% in the last 12 quarters. Let me see. We got some more coming out, but these are a little bit further out, so we'll save those for tomorrow. Do you see any other ones, Will?
No, but they're asking if you could dig further down and see if anything's popping up in Disney or AMAT. But that's up to you if you want to dig deeper into the
Take a look at Disney. So take a look at Disney's history, and how. Let's take a look at what the stock did after earnings compared to what the options were implying. So we see here these bars up and down. That was the predicted move of the straddle prior to reporting earnings. So we see here it starts out at 0, and then the bar going up and down. That's the percentage move in either direction. So I'm going to hover over this one over here as an example. On August 4th, 2020, after the market closed, Disney reported earnings. It was up 8.8%. The market was implying that the stock would move up or down 5%. So we see it broke right through that straddle to the upside. So that's what this green bar is. It's shown that that move was beyond what the expected move was to the upside. This red bar, that's telling us the actual move to the downside. So on August 6th, 2019, after market closed, Disney reported earnings. The actual move was negative 4.9%. The straddle was implying a move of 4.1% in either direction. So that move broke through that implied straddle. Let's take a look at the history. So we see here, Disney, 83% of the time, the options overestimated the move. So the actual move was less than what the options were implying. The average of the implied moves was 4.4% in either direction, compared to the average of the realized moves, 2.6%. So we see there 1.8% differential between the implied and realized. Those are the long-term averages, and that's why we're seeing here, if you bought the straddle day before earnings, sold it the day after, that was a winner only 18% of the time, but on average, it was a loss of 26%. Credit iron condor, that would be kind of the reverse, where you're selling the out of the money call spread, out of the money put spread. That was a winner 83% of the time for an average gain of 38%. Let me take a look at the implied volatilities over here. So this is looking at what did the implied volatility tend to do after Disney reported earnings. And it's looking at a 30-day constant maturity. So an option that expires 30 days into the future. So we see here the average implied volatility crush is 23%. The average implied volatility day before earnings was 29.4. The average implied volatility day after earnings was 22.7. The average implied volatility 5 days later, 21.8. So it looks like it kind of continued to decrease following that earnings release. So that's what the implied volatility looks like from a historical perspective in Disney. Did you want to do another one, Will?
No, but we just had someone ask that there's an alert in the upper right-hand corner, option strategies detected. They're wondering what that means. Right.
So this is looking at, from a historical perspective, what tended to work and how it's lining up now. So we see here today's opportunities. Now this is using closing, the closing prices from yesterday because we didn't open yet. So it's looking at it detected an opportunity and a credit. It looks like a credit iron butterfly. So opening up historically 3 days before, closing 1 day after. In the last 11 observations, that works 73% of the time for an average return of 80%. So here's where you would be opening and closing, and that to mimic that, we see that these are the legs of it. I'm just hovering over not to go to the options chain. So you would be selling. I'm sorry, this is the butterfly, not condor. Did I say condor? This is the butterfly. So selling the 140 strike in the call and the put, buying the 130 put, buying the 150 call for receiving 508. I'm sorry, receiving $5.72. We think it's worth 508, so that's 64 cents theoretical edge. Calendar spread. So selling the near term, buying the far. If you did this historically 3 days before earnings, close it out day after in the last 10 observations, that was a winner 70% of the time for an average return of 52%. So to mimic that, that's the November 20th expiration. I'm going to hover over it. So this would be selling the 140 put in the near term and buying the 140 put in the December 4th expiration. Okay, so that's what you would be doing. If you click, let me see, if you click on this, I think it populates it. I'm just going to click on it, and it should populate the strategy for us. So here it is, selling the 140 put November 20th and buying the December, the 140 put in December 4th expiration. So that's a calendar spread, right? That's what this would be equivalent to this one. Let's see, Iron Condor, also opening 3 days before, closing day after earnings. Out of the last 11 observations, this was a winner 91% of the time for an average return of 35%. So I'm going to hover over it. So this would be selling an out of the money put spread, selling the 135 put, buying the 130 put, selling the out of the money call spread, selling the 150 call, buying the 155 call for a credit of $1.31. We think it's worth 92 cents. So that is a 39 cents edge. So if we click on that, here it'll populate. It goes to the options chain, populates the legs for you. So these are all the legs. If I hit the load strategy, that's what the strategy looks like. So as long as the stock stays anywhere within this range in the green, that'll be profitable. Keep in mind here, this is also important. $1.31 credit is if you're selling it on the bid, the midpoint's $1.65. You always want to try to get it as close to that midpoint as possible, right? Because the further you go away from the midpoint, the more fee you're paying to the market makers to execute that trade. So that's, just take a look at that. That's 34 cents. 34 cents for credit of $1.31. That's a big percentage fee to put on that trade. So you could always put your limit orders closer to that midpoint. Is this helpful?
Yeah, that's super helpful.
Okay. You guys want to look at two more or move on?
Oh, well, we had actually a question, and this is the second day in a row, but it came from, I think it was either Pavel or Mike. It's a relatively new issue. Well, actually, I think it may be even the first innings, PLTR, but it's a tech IPO, and they do a lot of business with the government, the CIA. It's a large data mining company, basically. And so if we could take a look at PLTR, let us know what the straddle's pricing for this first earnings. He was actually, I think, looking at a vertical spread. He's bullish the stock.
So I don't even think they have an earnings history here.
No. This is literally the first earnings.
This is going to be their first earnings.
Yeah.
Let's take a look. It looks like they have options available. So I'm just going to take a look at under options really quickly under this activity. And here is, so these are the different expirations lined up over here. So we see earnings is going to be November 12th. So it's going to cover this expiration, November 13th. I'm going to go over here, and right now that straddle, if you're looking at the money, is approximately $2.44, which is implying that the stock is going to move 16.7% in either direction in the next with 4 business days to go, 4 trading days. November 20th expiration, we've got a 20.5% implied move. So this is how it's lining up. Really, who knows? This is the first time it's going to report earnings, so there's no history. There's no way to really analyze it. Could be in. Let me just see how the options chain, how wide these markets are. So those markets are relatively, I'm looking at, where is it, 14.5? 10 cents wide here, 10 cents wide, nickel wide. So they're pretty tight. Those markets are they're not that wide. If you wanted to do something, it's not, the markets at least are pretty tight. Again, there's nothing really to look for from a historical perspective.
Well, we do have a brand new chameleon on. If you could just walk him or her through maybe just doing a vertical spread for a credit, if you wanted to, I don't know, maybe just show them how you click on it and you can see the payout diagram, something like that. If they just wanted to do a, let's say sell the at the money puts 14.5 and buy, a credit put spread or something for maybe buy the 13s for protection for 45.
So if you're just looking, like, for example, doing like a credit put spread.
Yeah, just see how it plots out.
Yeah, I'll just use this, selling the 14.5 put. I'm clicking on that bid. So that's selling the 14.5 put. If you do it on a bid, that's $1.10. If you go and buy a put for protection below that, let's say 13 for 45 cents, so there we go, 45 cents. If you do it on the offer, I'm going to load that strategy. This is what the payout diagram looks like at expiration. So as long as the stock, stays right here, goes higher, you got a little bit cushion to that downside here, but the credit is 65 cents, midpoint 73. So again, you want to pay attention to that because, just that alone, that's 8 cents, right? So that's more than 10%. If you're hitting that bid, 65 cents, you want to try to get as close as you can at 73 cents. But that's your credit. That's what the payout diagram looks like at expiration.
Cool. Super helpful, D. Thank you.
Okay. Let's take a look really quickly, because I promised to look at the ETFs and see what was moving yesterday, how people were rotating their money. So I'm going to first just use non-leveraged ETFs. So this is going to filter out those ETFs that are either like inverse ETFs or like double, triple, long, double, short type of things. And let's filter out by biggest movers. As you could see here, oil service sector, that was up 18.9% yesterday, trading 2.1 times its average daily volume. We see a lot of these oil service sectors, travel tech ETF, and we see energy, regional banking, surprising that's starting to go up. And maybe the idea is if we're opening up, more activity, maybe more people borrowing money. And you said that the interest rates started ticking up a little bit, oil and gas exploration. So this is another way to kind of play those sectors that can benefit from, the economy opening up to like travel, cruises, and hotels and all those things that have been locked up. Let me do, if there are no questions on this, I'm going to do a really quick fundamental comparison.
Sure.
All right. So let me take a look at Nike, because we mentioned last week, and Nike is an interesting story because they actually sell a commodity, right? Sneakers. And you would think, like, if you're selling sneakers, it's very competitive, but what they've created is a big brand. And if you've ever seen, remember when Steve Jobs took over Apple when it was doing really bad, like before they kicked him out, he went into like creating cartoons, that he sold to Disney. And then what was that? What did he have right before Apple? Pixar or something?
Well, he was in a bunch of different businesses, but yeah, he went out there and was successful in other ventures. That's for sure.
Yeah. So anyway, Apple at one point they called him back, and he had to come up with a marketing strategy. How to besides focusing on the product, he had to come up with a marketing strategy. And he did this video. You could go on YouTube, and he kind of mimicked what Nike was doing. He said Nike has this genius marketing because they sell a commodity, but they created a brand, and that's where you get your, that's where they're getting their margins. They created this brand. And it was very simple. What was it? Like, just do it. What is Nike known for?
That is one of them for sure.
So let's take a look at this Nike and how this compares right now to something like Google. So I'm going to compare these valuation ratios, their growth ratios, profit ratios, and let's just take a look at something like Google. So here's Nike, here's Google, right? And we're going to do a comparison. So we see here Nike P ratio 76, Google 34. So at least here on a valuation basis, Nike looks much richly valued. So let's see if we could find the justifications, at least within these numbers. We see normalized P 76 versus 37, still pretty high. Price to sales ratio, so this is price to over their revenues, 5.5. Google is a little bit higher, 7.8. Price to book, they're more richly valued, 21.95 versus Google 5.6. And so on down the line. Let's take a look at their gross margins. So gross margins for Nike 43.2, which I think that's pretty good for.
You would think for an apparel manufacturer.
Yeah, that seems pretty good to me. 43% is pretty high gross margins, but that compares to Google 54.6. EBITDA margins. So this is earnings before interest, taxes, depreciation, amortization. 12.1%. Google's 31.2. EBIT. That's margins 8.9%, Google 23.4. So at least right now, here's net profit margin 7.2 versus Google 20.8. So right now, to me, at least just comparing these, and I'm not going very deep into it, I'm just looking at like just top line numbers, but at least that on evaluation, it seems much richer. Gross margins though, to me, Google's looks better. Here, return on equity, Nike did do much better, 29.2%, Google 17.5%. Return on investment income, similar, very close. Operating margin, 8.9%, Google 20.3%. So it looks to me like Google has higher margins, but the valuation so far in Nike is higher. I think here dividend is negligible. Google doesn't pay a dividend. Let's take a look at growth. So here it looks like earnings per share growth. Nike's was negative, Google's was positive, 20.9. Revenue growth, Nike 4.1%, Google 19.7. So to me, it looks, at least so far, Google looks like a better deal. Operating income growth, Nike negative 5.7, Google 16.9. Gross profit annual growth, Nike 2.9, Google 17.4. Net income, Nike negative 5%, Google 19.4. So far what I'm seeing is at least valuation, profit, and growth to me looks like, just looking at these numbers, not digging deeper. So far, Google looks to me like the better deal. Let's take a look at their averages. So gross margin averages, Nike 44.5, Google 58.9. So those are 5-year averages. Profit margin, Nike 9.3%, Google 19.6%. So here Google looks better. Return on investment capital, here's where Nike does better, 22.7 versus Google 13.7. Return on assets, here Nike does a little bit better, 14.3, 11.7. Return on equity, Nike's a little bit better there, 30.9 versus Google 14.9. And here are the 5-year average PE ratios, 38.4 versus Google 34.9. So Google's kind of right there still. Here's 52-week average. Not sure Nike a little bit. Maybe Nike, is that getting hurt right now by the coronavirus? I don't remember. I thought they had some pretty good earnings. So this may have changed since they last reported earnings. But at least here, if I'm just comparing it on a high level, to me, Google looks like a better deal.
Hey, D, one of the big chameleons is asking to elaborate on the Sharpe ratio and how important it is. I know it's the end of the day of the show. I don't know if that's something quick. I know it's a big ratio that a lot of people use to, make decisions. We could save it for tomorrow, or you could go over it real quick. It's up to you.
Let's do it tomorrow because it's 9:30. It's right at the bell. I'm going to let people go, but we'll go over that tomorrow, and I'll do an example.
Also, Raj, I know you put a lot in the forum. You can put it there as well, but we will try to get to it tomorrow. Thanks, Dee. That was a great show. Thanks for joining, Chameleons. You have a great day, Dima. Thank you.
Thanks, everyone. Have a great day. Hope to see you tomorrow.